the mathematical wall, and the biological curse. The first $100,000 is not just a round figure in a bank account. It is a mathematical wall, a sheer cliff that most people will never be able to climb. And the point here is not that they were born under an unlucky star, nor that the world economic system is rigged against them, although many comfort themselves with these very thoughts. The reason for their collapse is much more prosaic and therefore more tragic. They fail because they absolutely do not understand the psychology of their own stupidity. I have spent 70 long years watching the smartest, educated people, possessing brilliant intellects, sabotage their own futures with their own hands, committing the same predictable mental errors. And I can state to you with absolute, chilling certainty, your brain is programmed to keep you poor. Let me be brutally direct, casting aside political correctness and false modesty. You are not waging war against the market, the boss, or inflation. You are fighting against millions of years of evolution that have hardwired a craving for immediate gratification into your genetic code. Think about your ancestors, those ancient humans who found berries and saved them for the next winter simply did not survive. Their genes were not passed on because they died of starvation or their supplies rotted. Those who survived and reproduced were the ones who ate what they found immediately, who consumed resources here and now. We are the descendants of these impulsive consumers, but we no longer live in caves. The rules of the game have changed fundamentally, but your brain did not get the memo. It still functions in Paleolithic scarcity mode, demanding immediate reward in a world where wealth is built on decades of waiting. This is the first and most important problem you must solve if you want to escape the rat race. You must realize the nature of capital. Capital is not just money for buying things. Capital is crystallized freedom. Capital is leverage. It is the only fundamental difference between being a biological machine forced to trade the hours of its only life for dollars and becoming a rational player capable of making decisions without the gun of financial necessity pressed to your temple. Without that first $100,000, you are just another worker bee in a huge hive, praying every day that your health doesn't fail and the boss's mood remains benevolent. One serious medical issue, one corporate restructuring, one economic sneeze in the global market, and you are destroyed. I am not exaggerating. I saw this scenario play out during the Great Depression. I saw it during every subsequent downturn. I saw it in 2008 when people lost everything they thought was theirs. But there were others, people with capital. They had options. They could buy assets for pennies when everyone else was dumping them in panic. They could wait out the storm sitting in warmth and safety. They could take on reasonable, calculated risk because they had a buffer, a margin of safety. People without capital were crushed not because they were stupid, but because they were powerless. And here is the truth that no one wants to hear. Achieving the first $100,000 has almost nothing to do with your IQ level. I knew geniuses who died in poverty, and I knew people with very mediocre minds who built huge fortunes. The difference was not in intelligence. The difference was in rationality. It was the ability to recognize and neutralize those psychological tendencies that force people to do idiotic things with money. The anatomy of self-sabotage, inner demons. Let me guide you through the dark labyrinth of what you are actually fighting against. You think your enemy is a low salary or bad luck. You are mistaken. You are fighting yourself. You are fighting what I call the psychology of human misjudgment. These are 25 hardwired tendencies that evolution gave you for survival in a tribe, but which become a deadly poison when trying to create capital in modern markets. The first tendency destroying you: overreaction to reward and punishment. At your core, you are a simple creature. You do what is rewarded and avoid what is punished. Sounds reasonable, doesn't it? The problem is that modern society has turned this scheme inside out. It rewards consumption and punishes saving. You buy a new car, and everyone around you compliments you. You feel a surge of pride. You drive a 15-year-old clunker, aggressively saving money, and people look at you with pity, considering you a loser. Your entire social environment punishes exactly the behavior that would make you rich. Every advertisement, every post on Instagram, every conversation with colleagues reinforces the wrong incentives. The second tendency: social proof. Humans are copying machines. If everyone around you is leasing a BMW and flying to Europe for vacation, your brain interprets this as the only correct behavior. It doesn't care that these people are drowning in debt. Your subconscious sees the crowd moving in one direction and screams at you to follow them. Your brain evolved to care desperately about the opinion of the tribe, because banishment from the tribe thousands of years ago meant certain death. Therefore, you spend money you don't have to impress people you don't even like. And then you wonder why you are bankrupt at 40. This is not philosophy. This is biology working against your financial interests. The third tendency: envy and jealousy. This is a particularly destructive force. You see someone with a bigger house or a better car, and something primitive in your brain starts to howl. This howl will cost you everything if you listen to it. I have seen envy destroy more wealth than any bad investment. People earning $200,000 a year live paycheck to paycheck only because they cannot bear the thought that their colleague bought a boat. Here, I want you to burn the principle of inversion into your brain. Instead of asking, "How do I get rich?" ask, "What makes people stay poor?" The answer becomes obvious as soon as you look from this angle. People stay poor because they cannot delay gratification. They stay poor because they care about the opinions of strangers. They stay poor because they allow their emotions to defeat arithmetic every time. The math is ridiculously, brutally simple. Spend less than you earn. Invest the difference in productive assets. Wait. That's it. That is the whole game. But simple does not mean easy, because you are fighting a brain that wants pleasure now, status now, comfort now. The fourth tendency: misreaction to contrast. Your brain does not evaluate things in absolute terms. It evaluates them only in comparison. You feel rich until you meet someone richer. You feel poor until you see someone poorer. This tendency makes you irrational. You get a 20% raise and immediately inflate your lifestyle by 25% because you compare yourself to some new reference point that has nothing to do with reality. When Warren Buffett and I were young, we didn't compare ourselves to successful people. We compared our spending to opportunity costs. Every dollar spent on consumption was a dollar that could not earn compound interest for decades. This is a rational comparison, but almost no one thinks this way. The fifth tendency: overreaction to deprivation. People hate losing what they have much more than they love acquiring what they don't have. This is precisely why people hold losing stocks too long, hoping to break even, and sell winning stocks too early, afraid to lose profit. This is why they cannot cut bad expenses from their budget. Canceling a streaming service subscription is perceived by them as a painful loss, although if they hadn't subscribed initially, they wouldn't care. Your brain perceives giving up daily coffee at a coffee shop as if someone is tearing food out of your mouth. Meanwhile, you spend $500,000 a year on this ritual. Over 20 years, that is $50,000 that you burn simply because your brain cannot handle the feeling of deprivation. The illusion of knowledge and the authority trap. Let me tell you about compound interest, as everyone pretends to understand it. But in reality, no one does. Compound interest is the most powerful force in finance, but it is completely useless if you have nothing to invest. This is the tragedy. People read about how Buffett got 20% annually for 60 years and think, great, I'll do that too. But they have $500 and 3 credit cards with an 18% interest rate. They don't have a compound interest problem. They have a capital formation problem. Here is what compound interest looks like in reality. In the beginning, it is insulting. You save $6,000. You earn 10%. That is $600 before taxes. Then your car breaks down, and the repair costs $900. You feel like an idiot who tried in vain. It is here, at this stage, that 90% of people give up. They cannot bear the psychological pain of watching small numbers grow at a turtle's pace, while life continues to punch them in the face. I felt no delight from compound interest in my 20s. I suffered, worked, watched tiny returns that weren't even enough for a vacation. But the discipline to continue, despite everything, that is where fortunes come from. Not from genius, but from a stubborn refusal to give up when giving up. Seems like the emotionally correct decision. The 6th tendency: availability. Miss waiting. Tendency: your brain overestimates vivid recent examples and underestimates dry statistical reality. You know someone who got rich on cryptocurrency and think this is a viable path, ignoring the thousands who lost everything. You remember one stock tip that worked and forget 10 that failed. The rational approach is to ignore stories and trust systems. But humans are creatures driven by stories. Every story of a lottery winner on TV makes 1 million people spend money on tickets because a vivid image defeats the mathematical reality of probability. The 7th tendency: influence from mere association, authority bias. You trust authorities even when they are wrong. In the tribe, disobeying the chief meant death. But in modern finance, authority figures are usually just trying to sell you something. A financial advisor gets commissions. The media needs clickbait. An economist is promoting their book. They are all optimizing their interests, not yours. But your brain continues to treat them like tribal elders who care about your well-being. I will be blunt about financial advisors. Most of them are mediocre salespeople who couldn't beat the market even if their lives depended on it. They will take 1% from you annually to put your money into expensive mutual funds that lose to index funds. Over 30 years, this 1% commission turns into you retiring with 30% less capital than possible. But they have a nice office. They wear expensive suits, and your brain screams, "Trust authority," while they quietly rob you. The 8th tendency: doubt avoidance. Tendency: your brain hates uncertainty. When you don't know something, you experience physical pain. You rush to eliminate doubt by making any decision. even a bad one. This is exactly why people sell assets in panic during a crash. The uncertainty of whether the market will recover becomes unbearable. They sell at the bottom just to stop the discomfort. I have lived through more market crashes than most people have had birthdays, and every time the same thing happens. Smart people who intellectually understand compound interest completely lose their minds when their portfolio drops by 30%. Emotional pain overrides logic, and they take actions guaranteeing a permanent loss of capital. Volatility as the price of admission. Here is what you need to understand at a molecular level. Market volatility is not a bug, it is a feature. It is the very feature that creates returns. Stocks pay you a premium for tolerating psychological discomfort. If owning stocks were pleasant and easy, they would yield 2% like bonds. They yield 10% on average, precisely because most people cannot bear the sight of their net worth fluctuating wildly. This volatility is your compensation for rationality in the moment when others panic. But your brain does not think in 30-year periods. It thinks in categories of right now. When the market drops 20%, your amygdala lights up as if a predator is chasing you. Every instinct screams, danger. Run. Do something. The rational action is to do nothing, or even better, buy more. But rationality in this moment feels like stepping into an abyss. The ninth tendency, incentive-caused bias. People are predictably irrational when their salary depends on it. A realtor tells you to buy now because prices will never be lower. A mortgage broker pushes for the biggest loan for you. A car salesman explains why leasing is profitable. None of them are formally lying. They simply think in a way that is profitable for their earnings. Your own incentives distort your thinking too. You want to believe you deserve this vacation. You want to believe an expensive car is justified because you work hard. These are human desires, not evil ones, but they will leave you destitute if you allow them to outweigh arithmetic. I have always used counter-incentives. Every time I am tempted to spend money on stupidity, I calculate what that sum would turn into if invested for 30 years. That BMW doesn't cost $40,000. It is $200,000 of my retirement money. When you look at things from this angle, the old car suddenly starts to seem much more attractive. The 10th tendency, excessive self-regard. Tendency. You believe you are smarter, more competent, and luckier than you actually are. 90% of drivers believe their skills are above average. 90% of investors think they can beat the market. This tendency makes you overconfident and vulnerable. I have known many brilliant people, worked with the best minds in business, but I have never met anyone smart enough to consistently outplay markets through active trading. The math is against you. Commissions are against you. Professionals who spend 80 hours a week on analysis are against you. And your own psychology is against you. But people keep trying because they cannot imagine that they are not special. Want to know what true special looks like? Being special is having the discipline to live below your means for a decade. Being special is continuing to save when your portfolio is down 40%. Being special is ignoring your brother-in-law's hot tip. This is special behavior because almost no one is capable of it. But it is not sexy. Therefore, people continue to chase the fantasy of wealth through cunning instead of wealth through patience. The debt hole and 7 years of silence. Let's talk about debt, because here I see the most impressive stupidity. Debt is the opposite of compound interest. When you have invested capital, It works for you. When you have debt, compound interest works ruthlessly against you. A credit card at 18% is a tool that increases your poverty while you sleep. I have seen people with an income of $100,000 living at zero because they financed everything: the car, furniture, vacation, even daily expenses. They think they are living well. In reality, they are building a prison one monthly payment at a time. The rational move is obvious: destroy all debts before investing a single cent. But this means admitting that you cannot afford your lifestyle, and people will do anything to avoid this admission. The 11th tendency, reciprocation tendency. When something is given to you, you feel an obligation to give something in return. Marketers know this. Free samples, free consultations, bonus points on cards. You feel the bank is generous to you by giving cash back. Meanwhile, they charge merchants 3%. Merchants raise prices, and you pay for your own rewards yourself. Plus, the psychological game of chasing points makes you spend more. I never play these games. I have never optimized credit card points. The mental energy people spend on these schemes would be better spent figuring out how to earn more. The 12th tendency, over-optimism, or simple pain-avoiding psychological denial. You think rules don't apply to you, that you will be the one to get rich on day trading, house flipping, or drop shipping. This tendency makes you vulnerable to any get-rich-quick scheme. I will tell you a secret. The system beats almost everyone. People who become rich do so through boring, unglamorous capital accumulation over decades. They are not special. They are disciplined. There is a difference. Let's discuss the timeline, because this is where people's expectations destroy them. Creating the first $100,000 from scratch takes most people 7 to 10 years of aggressive saving. This is not a guess. This is math. If you save $1,000 a month and get 7% annually, you will reach the goal in about 8 years. Most people cannot digest 8 years of discipline. They want it faster. They start looking for shortcuts, options, cryptocurrency, guru courses on passive income. They convince themselves they can hack the system. Then they lose money, get disappointed, and quit everything. They would have been better off just accepting this time frame and grinding it out day after day. This period feels unfair. I understand that. You work, sacrifice, and for years it seems like you are standing still. Your friends post photos from resorts while you eat rice and beans. Your colleagues drive new cars. The social pressure is enormous. But here is what they won't tell you. Most people in those photos are drowning in loans. The colleague in the new car just signed up for 6 years of slavery. They look successful, but in reality, they are trapped. Discipline is loneliness. The path to $100,000 requires you to be ruthlessly honest about your performance. Are you actually saving aggressively or looking for excuses? Are you avoiding stupid debt or financing your lifestyle? Do you stay in the market during volatility or check your portfolio every day and panic? People lie to themselves. They call themselves investors, when in fact they are gamblers. They say they will start saving seriously next year, but next year never comes. The calendar flips, and they remain broke. Discipline is driving past the car dealership when your bonus comes in. Discipline is saying no to a vacation friends are planning. Discipline is watching your portfolio drop 30% and buying more. Discipline does not create beautiful moments for Instagram. It creates something more valuable: optionality. When you have capital, you have a choice. You can walk away from a toxic job. You can start a business. You accept what life gives, and you smile. The 14th tendency: stress influence tendency. Under pressure, you revert to primitive behavior. You seek comfort. In a crisis, most people's finances crumble because stress overrides rational planning. In 2008, people sold everything at the bottom because they couldn't handle the stress. The solution is not to be fearless, but to build systems that protect you from your reaction to stress. Automate savings. Create rules in advance. Most people improvise and lose. The 15th tendency: evidence distortion, confirmation bias. Real estate seems safer than stocks because you can touch it. And everyone has stories about an uncle who made a fortune on apartments. But statistics say the broad stock market has returned 10% over a century, while real estate, factoring in taxes and repairs, often loses out. But the boring, diversified approach beats exciting stories almost always. Boredom doesn't sell. Boredom doesn't go viral. So you are surrounded by stories of exceptions, while boring winners get rich in silence. Metamorphosis. Life after the wall. Let me clarify what $100,000 actually means. It is not wealth. It is not even that much money in absolute terms. But it is proof. Proof that you can control yourself. Proof that you can delay gratification. Once you prove this to yourself, the next $100,000 comes faster. Psychology changes. You no longer fight yourself so fiercely because you have built mental muscles. You survived the boring years and saw compound interest start working. The second $100,000 usually takes half the time of the first. By the time you reach $500,000, the annual return on capital will start to exceed your salary. That is when people will start calling you lucky. They won't see the decade of discipline that built this foundation. The 17th tendency: inconsistency, avoidance tendency. If you see yourself as a person who is bad with money, you will behave accordingly, even if it kills you. Your brain would rather be consistently wrong than admit the need for change. The shift that matters is realizing that you are not bad with money. You are simply operating with brain firmware created for a different environment. The 18th tendency: expectation of fairness, or Kantian fairness tendency. You expect the world to be fair, that hard work will be rewarded. This tendency prepares you for disappointment. The market is unfair. It is just math. If you feed compound interest capital and time, it works. If not, it doesn't. Your moral worth does not matter. The universe does not reward suffering. It rewards capital formation. The 19th tendency: influence from aging. Your mind is an asset that loses value over time. Every year of waiting is a year you won't get back. I have seen people who waited for the right moment until they hit 65, and they panicked. The cruelest part is that when you are young and time is your main advantage, you don't feel the urgency. When you are old and feel the urgency, you no longer have time. So start today. The 3 pillars of wealth. I will finish with the only advice that matters. If you want to build wealth, do 3 things. Avoid catastrophic stupidity. No high-interest debts. No gambling disguised as investing. Don't blow yourself up. This will already eliminate 90% of troubles. Live below your means. This is not about greed. This is about freedom. Every dollar spent on impressing people is a dollar that cannot become your freedom. Choose optionality over comfort. Invest in productive assets. Boring index funds, good companies. Hold them forever. The first $100,000 is a wall. It is a test. Most will fail it. They will spend their lives making excuses. But if you pass this test, if you go through years of unglamorous discipline, everything will change. The compound interest curve will go up, and most surprisingly, your values will change. An expensive car will seem like a waste, a luxury vacation, a lost profit. You will stop being a consumer vulnerable to advertising and become a capital allocator. Get those first $100,000 by any honest means. Cut expenses to the bone. Work more. Ignore the mockery. Because as long as you don't have capital, you are playing a survival game, and it is rigged against you. Once you have capital, you play a different game. You have a margin of safety. It is a lonely, boring path. No one will applaud you. But on the other side of this path is a life most people will never know. A life where money works for you, not you for it. The choice is yours. Keep looking for excuses or start playing for real today. Because every day of waiting is a day of compound interest you will never get back.